Can you believe it's the end of August already? We're at the end of summer, kids are back in school, weather's starting to cool down a little bit, markets are starting to heat up a little bit. Let's talk about it in the August update. Hi everybody, I'm Brian Ullman, a financial advisor here at Ford Financial Group. And if you watched last month's video, we talked a little bit about how August and September can be pretty weak months for stocks. As we get into late summer, the S&P 500 can tend to drift a little bit lower, or if it goes up, it doesn't go up at the pace it does in other parts of the year. Well, we're at the end of August, as I mentioned in the intro, and things have gone pretty well. In fact, we're reaching new all-time highs here, even just in the last week. I'll show you one of the LPL charts of the day, and you can see here that the S&P 500 has made the 50th all-time high this year, and the all-time record for any one year is actually 77 new all-time highs with the S&P 500. That was back in 1995, and incredibly, we are on pace for 78 all-time highs for the year. Now, we haven't even gotten to Labor Day yet, so a lot can happen between now and the end of the year, but it just kind of goes to show the strength that we've seen in stocks, and a lot of it has been based on the recovery. We did see a little bit of a dip this quarter as the Delta variant kind of started to rear its ugly head. There were some fears about shutdowns going on again, kids getting sent back home from school and so on, and we haven't really seen that. I don't think there's much of an appetite right now to shut the world down again. Folks who are worried about the coronavirus have gotten their vaccines. Folks who haven't gotten their vaccines aren't as worried about the coronavirus, and so there's not really that appetite, that political appetite to shut things down again. And as an investor, that's an important element here, right? If we're not going to shut things down, call a timeout and take all the economic players off the playing field, things are going to stay open and companies are going to continue to benefit from this surge of everybody getting back out there, traveling, spending, making up for lost time for the last year or so. So where do we go from here? Well, we're not necessarily out of the woods yet. We're getting into September, which again has been historically weak, but when we are reaching all-time highs at the pace that we're reaching them now, that usually happens in bunches. And so if history is a guide, history doesn't repeat itself, but if it's a guide, it's going to show us that markets are going to be moving higher potentially here in September and continuing to reach some of those new all-time highs. It's also pretty common when we get late in September that we do get some volatility as we wait for October, where we're at the beginning of the fourth quarter of the year, and we start to get those third quarter earnings reports in for more companies. And so we're not out of the woods yet. Things are looking good. Corporate earnings are high. The economy is doing well. But there is still some of that seasonal volatility that might come from equities. And so that's important to keep in mind as you watch markets and you watch your portfolio. The same old threats that we've been talking about for some time now still exist. In fact, one of the things that gets discussed a lot is stagflation. Now, if you're of a certain vintage, you'll know what I'm talking about. But for those who don't know what I'm talking about, what we're talking about is slow growth plus inflation, and that creates an investing in an economic environment called stagflation. Now, we're not too terribly concerned about stagflation right now. We have had a high pace of inflation recently, although that pace of inflation looks like it's starting to recede a bit. And so while inflation means prices move up and they're unlikely to move back down, the pace that prices are moving higher from here is going to slow down a little bit. And then on the flip side, we're seeing lots and lots of growth economically. And so that's going to help things as we go forward and can keep that stagflation worry at bay. Although it's still on some people's radars. So as we watch growth and as we watch inflation, we want to make sure that growth stays at a healthy pace and inflation kind of is limited to a healthy pace, and that should help keep things in check. And so we're not going to have to worry so much about inflation and stagflation and stagflation pressures that can come on stocks. Now, as we look forward into the fourth quarter and into next year, again, it comes down a lot to what the Federal Reserve is doing at their Jackson Hole meeting and even into the future, and how they're going to provide guidance on what's going on with the Fed fund rate, interest rates, and what they see from the economy as well. So it's going to be an important next few months, particularly for the fixed income or bond side of your portfolio, to see how yields are reacting to inflation, because higher interest rates makes life pretty difficult for your bond investments. So I hope that helps kind of bring you up to speed as we reach the end of summer. Have a great Labor Day weekend, and we'll connect back again in September to talk about what's going on as we get into the fall.